My name is Wesley Boudreau, one of the financial advisors here with the Retirement Group. Today we're going to give you a quick update on the ExxonMobil pension plan, kind of a quick review, and then also let you know where the interest rates fall for the lump sum calculations for both the third and fourth quarter of 2021. Before I get started, I just want to remind everybody again that the Retirement Group we are not affiliated with, nor are we employed by ExxonMobil. Throughout the course of this, there's a couple items you might want to pay attention to. There is a Q&A box on the webinar screen. If you have any questions, feel free to put those in there. Your information, your name will be kept anonymous, and I'll be sure to try and address as many as I can at the end of the webinar. If we don't get to everything, we'll be happy to follow back up with you and provide those answers as well. There's also a chat box where we will be putting some information there. Some items may be information like how to follow us on LinkedIn if you want to stay up to date on all the Exxon information we have as it comes out. Also, if you'd like to set up an appointment with myself or one of the other advisors in the office. And then if you have any interest in it, we are looking to try and better these, so there may be a survey link on there to let us know, how we did with the webinar or any suggested changes or topics to do in the future. If you take a little bit of time to do that, I think we might be sending a box of cookies your way, so it may be worth at least that as well. Now, before we get started, I just want to remind everybody again who the Retirement Group is. Again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. We've been doing this for just shy of 30 years or so. We work with about 20 different companies, and Exxon obviously is one of the big companies we do a lot of work with. The reason we focus on just a few companies is it allows our advisors to have a deeper understanding of your benefits plans inside and out, so we can hold your hand through the transition process and help you avoid a lot of mistakes we see from time to time that retirees make, and also provide you some sound planning guidance prior to retirement as well. And we've got offices throughout the country, so rest assured if you need to sit down and speak with somebody face to face, we can still accommodate that. But obviously we can provide webinar meetings, phone calls, emails, fax, all that as well. And then one of the biggest things we do recommend that you take us up on, even if you have already and it's been a while, we can update it, but you need to run a complementary cash flow analysis, especially for Exxon employees, because this is it's an analysis where we can take a look at your retirement date, look at your spending, look at what you save throughout the company, and make sure you're on the right path to meet those goals. And we'll come back, we'll be able to tell you if you can successfully retire at the date you were thinking about, whether you can go earlier or whether you should stay on later. And once you have that, we can help you plan accordingly and maybe look at some different options from there. So again, it's not a one-size-fits-all, but it's very important to look at that and also review the differences on the pension plan, whether it's a lump sum or the annuity, which we'll talk about here momentarily. So as you transition and leave Exxon, there's really three common sources of income you'll be seeing. Number one, your Social Security. Generally speaking, you can take that as early as age 62 or defer it to age 70. But again, the full retirement age is going to be somewhere between 66 and 67 for most individuals. Now, if you have questions on this, we can actually run a Social Security analysis to give you a full breakdown of all the different claiming strategies for yourself, or if you're married, you and your spouse, and let you know what the best options are going to be for you. Now, you've also got with Exxon your 401k and your defined benefit plan. And the defined benefit plan, which the pension plan is what we'll talk about here today. But again, the 401k is going to be your defined contribution plan, in which case you and Exxon have been making contributions all this time, with the exception of the last year or so. But we're going to be looking at those coming back again soon. And that's going to grow or shrink depending upon the market movement and the performance of the account. And once you retire, you can start taking distributions from that or roll it over to an IRA. On the pension, you have the option of taking it as an annuity or a lump sum. So when we talk about those different choices, again, it's a defined benefit. It's a classic formula calculation, which we'll go over in just a second, that determines what your single life annuity payment is going to be for the rest of your life. From there, you have alternative choices. If you want to make sure that your beneficiaries get something, you can add a period certain to it, so that way it's going to be guaranteed for 10, 15, or 20 years beyond the original 5-year guarantee they provide. Or maybe you're married and you want to make sure your spouse is covered. You can look at a joint and survivor annuity, so that both of you are going to be covered as long as somebody is alive, and you can maintain a 100% payout, or it can drop to 75, 50, 25% payout to your surviving spouse if something like that were to happen. What we're going to talk about today is going to be the lump sum calculation. And again, what happens is the lump sum uses interest rates to determine what you're actually going to get paid in order for you to go and try and recreate that annuity yourself. So as interest rates change and interest rates come down and they're lower, Exxon has to give you that much more money in order to try and recreate that annuity. So that's what we'll talk about, the interest rates here. And the interest rates are going to be different for different people. For most people on this call, it's probably going to be the Pension Protection Act segment rates. The other option is the GAT rate, which is the 30-year Treasury rate. But that's going to be for those that have been around a little bit longer. You need to be over 63 and over 23 years of service at this point. So it still applies to some of you, but for most people, it's going to be the Pension Protection Act segment rates, which we'll go over. Now, as far as the formula for the defined benefit plan, again, it's going to be a formula to determine how much of a monthly income they're going to give you, and then all those other options I just mentioned are derived from that. So the formula is going to look at it's 1.6% times your years of service times your final average pay, and then they claw back the Social Security that they've been paying in for you over time. Again, whenever you get your check, Exxon pays half the Social Security tax and you pay half the Social Security tax. And as far as vesting, you just need to be there for at least 5 years, but then there's going to be differences as to whether you're a terminee or retiree as far as what percentage of this you will actually be getting as well. And then if we look at that breakdown, in order to be a retiree, which is very important, you need to be at least 55 years old and have 15 years of experience. So you want to make sure you make it to that number, because at 55 plus 15 or over that, you're considered a retiree, which is a lot better than being considered a terminee. A retiree is going to reach 100% of their pension at age 60. A terminee will have to wait until age 65. Also, a terminee does not have the lump sum options available to them. They just have the annuity options. And if you take anything prior to age 60 or prior to age 65, depending upon which one you are, the penalties are much more severe on the terminee schedule. So let's look at somebody who's a retiree and figure out, okay, maybe I'm retiring at 57. Am I going to get my full pension? Well, the answer is no or maybe. So if we take a look at this chart, essentially as a retiree, any year you decide to commence your benefits prior to age 60, there's going to be a reduction for an age penalty, and it's essentially 5% per year. But again, it's not just a year-by-year basis, it's daily, so they calculate it out daily. So let's say somebody who's going to retire at 57 and decides to go ahead and take their pension at that point in time, they're going to have 15% reduction, so they're only going to see 85% of that pension provided to them. Now, they do have the option to actually to retire and defer their benefit. So they could retire at 57, and let's say maybe they go and work, consult, or do something else for a couple of years. They don't need the pension. They can defer it out to age 60, so they get that 100% payment as well. It also goes hand in hand if you're trying to follow and track the interest rates for lump sum calculations. We worked with a lot of ExxonMobil employees over the last 2 years that we did this as interest rates were changing. They may have retired, but we had them hold off a month or quarter or two to actually claim their pension lump sum, because interest rates were dropping, which meant their lump sum was going up. So let's take a look at how those interest rates change and how they affect the lump sum. So on this slide, you see this kind of seesaw pattern here. Again, I've mentioned it once or twice. As interest rates change, so does the lump sum. So think about it like a mortgage. When interest rates are low, you can afford a bigger house. When interest rates are high, the payments are higher for you. So what's going to happen is, essentially, as interest rates go down, which they have over the last couple of years, and they went back up, and then with the pandemic, they've come down pretty dramatically, and bottoming out about the first quarter of 2021. So as those went down, essentially what's going to happen is Exxon looks at your income annuity, figures out how long you're going to live based upon life expectancy, and they're going to take a look at, okay, how much do we have to give you based upon interest rates for you to go out and try and recreate this income stream. So if interest rates are lower, they have to give you more money in order to try and recreate that. So we take a look at that seesaw. As interest rates go down, what's going to happen is the change in interest rates, about a 1% change in these interest rates, is going to equal out to about an 8 to a 12% change in your lump sum calculation. So if interest rates go down by 1%, generally speaking, we'll say that your lump sum is going to go up by about 10%, give or take a little bit. On the flip side, interest rates have been low. They've been coming up a little bit, and if they keep going up, if they go up 1%, you can see your lump sum go down by 10%. So let's say you have $1 million lump sum right now, and interest rates go up by 1%. You can see that come down to roughly around $900,000 or so. So that's why it's really important to monitor those interest rates if you're looking at retiring in the next year or so, because if you're taking the lump sum, in theory, you could be working for free or reduced payment the last year of your career, because maybe you make $100,000 but you lose $70,000 in the lump sum. So the net effect is maybe losing only working for $25,000. So the question is, do you want to do that? But again, we'll be able to keep you updated on the interest rates and give you updates quarterly on them and let you determine the best way to pull that trigger. But let's kind of zoom in here and take a look at these rates so that you have a better idea of what we're looking at. Now, as far as I mentioned before, there's the Pension Protection Act segment rates, which are broken down to 3 segments. There's the first, second, and third segment. The first segment correlates to the first 5 years of retirement. The second segment correlates to years 6 through 20, and the third is going to be years 21 and beyond. And on the far right-hand side, we have the GAT rate, which is the grandfathered rates. This is the 30-year Treasury rate at 95%. So again, this is for only individuals that are over 63 with over 23 years of work. Now the rates, what they do is they use the last 2 months of the 2 previous quarters to determine what the interest rates are going to be for that quarter. So for fourth quarter 2021, if we go across, we'll see the short-term rates are going to be 0.62%, 2.77%, 3.43. We look right below there, the ones for third quarter right now is 0.6, 2.73, and 3.57. So a very, very minor change between third quarter and fourth quarter, and a lot of that's due to the rates coming down in June. And we've also seen them come down a little bit lower again in July, so that's not going to be used. But once we get August, September, that'll tell us what the first quarter of 2021, excuse me, the first quarter of 2022 is going to be. But if we look at these, and we go on the bottom, let me zoom back in. I apologize. If we look at the bottom, this is going to give you what the rates were about a year and a half ago or so, at the end of 2019, beginning of 2020. If we look at that middle segment, that's going to have the biggest effect on your calculation because it covers 15 years. But it was up in the fourth quarter 2019, 3.64. Now we're at about 2.77. So again, we're looking at that roughly 1% change or so in those. So if we just go back to where we were before, we could theoretically see that 1% change. The question is, how quickly will it happen, and what's your retirement situation? So that's why it's really important to run that cash flow analysis, kind of see where you are at this point, and then that way, if you're looking to take the lump sum, we can monitor those different options for you. So with that, I want to just go ahead and remind everybody, if you do have any questions, it's really important to run that cash flow analysis to dig into your personal situation to really give you the best answers. But just give us a call and we can schedule an appointment. You can reach us at 1-800-900-5867, or you can email us at info@theretirementgroup.com. I think some of those links were in the chat box for LinkedIn or for scheduling appointments. But if you're tech savvy, there's some QR codes up here. You can go and hold your phone up and get into that as well. And so with that, I want to kind of wrap it up. I want to answer 1 or 2 questions we have here, and then if there's any other additional questions, just give me a call. We'll be happy to go through them. But one that came in was can I change my election? Okay, so it's going to depend on when you actually did this. So I talked before about the ability to retire and defer commencement. So we've worked with people where we've caught them kind of on the tail end of their retirement planning, or maybe they didn't do any retirement planning, and they'd already put in for their paperwork to get the election done. They retired and they were, let's say for instance, going to be going in the fourth quarter of last year. We saw this a lot, and we caught them before they actually finished in the paperwork in, but they'd already requested the election forms. But we explained to them, with the way the interest rates were dropping from fourth quarter to first quarter, and for some of these, the bump was about $23,000. Some were about $17,000 in the lump sum payment. So we explained to them, go ahead and cancel that and order new pension election forms for January of the following year in order to do that. So yes, you can change it, but that's prior to actually signing and submitting the information. So you got to be very very careful on that as well. And then one other question, which and I apologize, I should have put this in there because we usually do, was the option to actually split the annuity and the lump sum. So again, one of the things Exxon did change about 5-6 years ago was made the election option a little bit better for you, whereas it used to just be either the lump sum or the annuity. Now you can also break that up. You can take it on a split strategy where you can break it up in 25% increments. So maybe you can do half annuity, half lump sum, or 25-75%, vice versa. And that's one of the other issues we mentioned about running the cash flow analysis. We can run those different scenarios to show you what it looks like, not just now, but in 10, 20, 30 years down the road. So you might want to run 3 different scenarios for different dates. Maybe you want to say, okay, if I'm going to retire at the end of 2021, what does it look like if I take the entire lump sum, or maybe a 50-50, or maybe 100% annuity? We can run those side by side for you to show you what it looks like down the road, and explain all the different pros and cons to that as well. And then also, again, adjust the dates. So that's why it's most important to kind of run that to see exactly where you stand. And then from there, if you need help or guidance, then we can obviously help you with the investment side of things as well. But to keep it short, I want to wrap it up there. So if anybody else has questions, feel free to give us a call. We'll be happy to go through it. But I just want to remind everybody again that you can reach us at 1-800-900-5867. And again, it's important if you're looking at taking the lump sum or leaning towards a lump sum for the ExxonMobil pension plan that you have a good understanding of these interest rates, or at least give us a call so we can keep you up to date on them as well. So again, I want to thank everybody for taking a little bit of time out of their day, and I hope you have a great day.